Okay, everybody, so we're going to take a look at my position sheet, and so let me just explain how this works. You have a bunch of markets, and then what you're looking for is everything to line up for a trade. So the first thing is relative strength. Why? Because relative strength tells you which markets to long and short, relatively speaking, meaning relative to other markets, not just to its own self in terms of trend being up or down, but relative to other markets or a particular market to gauge its strength and weakness. So it's basically, for me, the way I view it is just a market selection tool for longs and shorts. That's all it is, right? So if it's above zero or one, if it's positive, you want to look for long. If it's negative, you want to look for shorts. And then on top of that, you add trend. Trend uses its own data, meaning the market's own data, to determine if the trend is up or down. And it's, in my opinion, should be consistent of 2 time frames. Why? Because you could have a daily up trend and an hourly down trend. And if you're only looking at one, you'll be looking at the hourly downtrend, a lower time frame, not realizing that the overall daily, which is a higher time frame, is up. Therefore, you need both the hourly and the daily, or both the daily and the weekly, at least 2 time frames, 2 higher time frames, to tell you if the market is up or down. That's just something that I've realized. It's also a source of many people losing money when they see these when they think there's a trend change, especially on the intraday, but there isn't. It's just a deep pullback. So if you've traded intraday, you know that it's a 5 minute or something like that. It looks like it's going down, but the hourly is clearly up and the daily is clearly up, and selling that 5 minute downtrend is just going to create short covering that is required to push prices higher. Anyway, so where am I? So we're looking at relative strength, then we're looking at trend. This trend composed of 2 time frames, daily and weekly. And then we're looking for a pullback. And after that, as it pulls back, we look for a situation. All right, so this would be your setup, which would be a spring or up thrust. And then, as it's in a spring or up thrust position, we want to see if there's buying or selling by way of a change of behavior. So everything is structured the way it should be. Relative strength and trend and pullback, then position, then buying that position. And then you decide. So we'll just see what is lining up. And you see that nothing here is really lining up. Over here, there's strength, there's trend is up, there's a pullback, but there's a change of behavior. And I'll show you how this looks. So this is not that great on the EMD, which is your mid cap. You see that the trend is up, but as the trend is up, there's something going on, meaning there's some selling. So that could possibly be setting up the pullback. All right, so setting up the pullback to go long. All right, why? Trend is up, right? See that? It's up on the weekly, daily. But here, the market is pulling back because there's selling, and there's significant selling right here. And, and then this chart here, this is really important. I can't tell you how important this is because, let me explain something. So a lot of times what happens is the majority of the retail crowd, when they take a trade, they actually get the direction right. There's a lot of folks that actually get the direction right. Meaning, what I mean by that is they'll look at the daily or weekly or whatever hourly and see it's going up. A lot of the Forex traders will look at the 4-hour and it's clearly going up. Now what happens is, maybe they'll get in here and it'll do something like and it'll get them out right here. Right? It'll get them out right here, or it will do this. And it'll get them out right here. Right? Because we know that the idea of higher high, higher lows is bullshit. Alright? I don't know how else to explain that to you. Go look at any chart. You will never see clean higher high, higher lows. It just is a fictitious model. It's actually an oversimplified model. So the idea here is that your stops always get hit and then it goes in your direction. And so how do you deal with this? Right? How you deal with this is you need to have heavy volume, the presence of heavy volume. Why? Because as the markets go lower and lower and lower, they're already exhausting on the way down, meaning they're selling, they're selling, they're selling, they're selling. On top of that, it's very hard to absorb heavy volume after the thing has already pulled back. So it's already pulling back, and on top of it, you expect, them to absorb this. It's already pulling back. It's already sold. It's already sold high, and now you expect smart money now to at lower prices all the way at this edge to absorb high volume? You expect that? So this is, in my opinion, is almost like a little insurance policy. Insurance for your stop. Insurance for your stop, and your stop should be below this high volume area. That's the opinion that I have. You could have your own, but the logic is very clear. Is that they already sold up here, selling. It's going to take a lot of effort to absorb this high volume here. All right, more effort. It already took effort to bring price down during this pullback. Now it'll take even more effort to take out this high volume areas, these high volume bricks or boxes, right? Because not only do they have to fight those who are underwater, because they'll be covering to buy. Right here, they'll be covering to buy. Whoever's wrong on their position sees this as an opportunity to break even. So they'll be going against them, the break-even traders who took the other side of this high volume, who have an opportunity to exit at break-even. They'll be fighting against new longs as well, because they'll see a pullback to an area that was right, meaning the guys who bought here, they made money on the way up. So when you see that a lot of people bought here and price went up, guess what? I went in at those prices also. Why? Because these guys, they got it right. Now I have an opportunity to get in at the same or close to the same prices as them, so that I have a shot of making money. So existing shorts have to cover because they're underwater, and new longs want to buy. So existing shorts want to cover because of fear of loss, because they're losing money, and new longs want to enter because it's a opportunity to enter. All right, because they don't want to miss out on the pullback to go back up. All right, so that's the idea. So this is why high volume is important. I mean, that's the psychological. So here, uh, this chart right here, it shows high volume areas. It shows high volume areas. You don't need this chart, but you need any chart that shows volume at price. If you see the volume at price, you know that the buyers bought that level and they were right because price went up. So you want to be right too and get in on the opportunity. All right, so I've explained the logic of this chart and all that. All right, so where am I? So yeah, trend is up, trend is up. You had some selling over here, and you see it's proven because of this bar being the biggest in 70 bars, selling. And then you have, they gave an opportunity here. It went down. This now I don't know about, because now you have like all this could be buying or selling, but it's just volume. There's a lot of trade activity and price seems to be going up a little bit. So I'm not really sure about all this now, but here was obvious. Why? Because you have that high volume, and especially when you have a hard crack after it. Usually if you have a thrust after high volume, there's distribution and there's nothing, because you see what happens is when there's distribution, right? When there's distribution or accumulation, there's usually big bars after it. Why is that the case? Market participants that were supporting the market, they realize that there is distribution. They're not stupid. They realize that there's distribution here. They will remove their buy orders supporting the market. When they remove their buy orders supporting the market goes straight down. This is exposed by big bars. So if I distribute over here, whoever's supporting the market is like, you know what? There's too much selling up here. That's not a good thing. Let me remove my buy orders. I'm not supporting the market anymore. I don't want to buy. I don't want to buy here. I don't want to buy here at these market support levels. So what's going to happen is the sellers will sell and there's nothing to buy. No buy orders, right, that are going to complement them at those prices. This is why you have these big red bars after distribution, always, and after accumulation. After accumulation, boom, right there. See, like here you have accumulation, and then starts, the price bars, they start expanding. They start thrusting. So it starts what is it called? Ease of movement or big bars. That's what starts happening. That's why you want to see this volume confirmed by big bars in a particular direction. It is telling you, yes, there's accumulation, or yes, there's distribution. Anyway, long story short, I don't know what to do with this market. The opportunity was here. It was just a pullback opportunity. It was selling, and then there was a little up thrust here, and then bang, broke it. This selling was the biggest in 2.5 times the average selling, with this fucker right here, which is the biggest bar in 100 bars. No doubt that this is distributive action. The way this broke down, giving you the order entry and making a little move, not that great because the trend is up. All right, so now I'm looking for accumulation. I don't know if this is accumulation yet. I can't figure this out, so I'm just going to pass on. All right, let's go to the ES. So, let's take a look at the ES. Trend is up right now. Moving over here. What do we see? We see first of all, we see a breakout, right? So when you see a breakout, you know that the market has a tendency to test the breakout or the accumulation area underneath the breakout. So you want to start examining where those levels of heavy buying is. So the first thing to note is that this breakout was on the biggest bar in 7 bars. biggest bar in 7 consecutive bars, meaning it's bigger than 1, 2, 3, 4, 5, 6, 7. It's bigger than all the bars except this reversal bar over here, this big one. So after that, it consolidated and banged. So this looks like a legitimate breakout, has follow through. All right, so we know that. Next, we know its trend is up, breakout, big bar. Now we're going to go to our tape reading chart and look for the levels. And we're looking at this area of the breakout to see if it, if it holds, where is it going to go. And one thing of note is this area right here. You have about 25 times 10,000, so about 250,000 contracts, I think it was, right here. That area is real sweet. Like, if it comes back down here, I am expecting the bulls to do something. All right, and I want to be really precise about this. So what I'm going to do is I'm going to profile this. I know that this is the area. Let's just profile this. Bring it down. There's something up here. That's probably this guy. Right? Might be a spring there. But if you take it back a little, you get the exact level right here. So as the market pulls back into this area, you see that the high volume level right there, right? So I want to see how I'm looking at this level here if the market starts reacting, but there's also a level here, and that would be good for a spring. So let me mark that as well. So there may be the case that they pull back and they spring this area, and then after that, take it a little bit lower to these levels. Right, so spring of this, maybe a bounce here, and then this. So these are the two levels that are really obvious. All right, let's move on to the next market and kill. Oh, other thing I wanted to show, the ideas that I'm giving you, if you take something away from this, is when there's accumulation and distribution, there is ease of movement after it. Again, when there's accumulation and distribution, there is ease of movement after it. All right? So over here, if I was to show you, all right, where's some distribution, some accumulation? It doesn't have to be major accumulation distribution, but you should be able to identify one thing to note is where's the ease of movement. So the ease of movement is here. It's the biggest bar in 100 bars, and this is the biggest bar in 100 bars. So where's the accumulation here? The accumulation was this area. This accumulation area led to this breakout, led to some profit taking or some selling up here on that 31 print right there. See that? That 31,000, and then you have ease of movement. So what happens is, usually when these accumulation distribution areas get tested, they immediately react, and you get a profitable trade, hopefully. So you have this 31,000, that was a distributed action, ease of movement after that. Then it just tested and it stopped right there and pulled back. And even here, where it says 100, right, ease of movement, if you look at the back, this accumulation activity. So now the rest of this I really don't know, but what I'm trying to show you is a simple, is this. I'll explain it. you have high volume, using anything that's volume at price. Volume at price. Whatever chart, whatever you use, it doesn't matter. Alright, so let's just say I'm using this tapering chart. Alright, so you have a box, right? Or you could use Renko or candlesticks, doesn't matter. Then after that, what I want to see is I want to see ease of movement. Ease of movement, and here's the point. Ease of movement confirms accumulation and distribution. Ease of movement confirms accumulation and distribution, and I'm telling you why, so you understand the reasons, and this is not just a claim, it's backed by evidence and logic that ease of movement is removing those buy orders or removing the sell orders. So if there is accumulation, they will remove the sell orders above that area, so you have a big green bar after the accumulation. In the case of distribution, they will remove the buy orders underneath that distribution, so you have a big red bar. And that red big bar is your ease of movement. Okay, so remember this. This is how you, the problem is a lot of the white clock traders, they're just looking at bases. Bases could be anything. You know, it could be ranges and all of that. I mean, maybe it is, maybe it isn't, but you need to see that heavy volume, evidence of heavy volume with a blah, with the ease of movement. So accumulation is not just bases. It's not, and bases doesn't mean it's automatically accumulation. Again, accumulation is not just bases, and every base is not accumulation. Okay, but high volume with ease of movement, that is pretty solid as what? As accumulation or distribution, because the ease of movement is saying I'm removing my orders because of this buying below, causing the big green bar. Again, causing the big green bar because the sell orders were pulled. All right, where am I? Let's go to the next. Again, over here, you see the ease of movement. In the background, I can't catch them all, but where was it? It's not clear up here, but I guess this 11 right there was the distribution brick. The distribution brick right there, but it's not very overtly clear. Yeah, but that's where it was right here, where you have the 11. So I mean, it's not really that much. If it was highlighted, it would be easier to see. So that's where it was. Okay, let's go to the next market, RTY. You can see all the selling, all the selling. Now the question is this a selling for a pullback to go higher? That's the question. And in my opinion, anytime you have two trends going up, chances are it's just selling for a pullback. You know what I mean? Now here we have a situation, all right? You see how clear this is. All this block of heavy volume, and look at these supports. Look at the ease of movements that just blows through the supports. This is the biggest bar in 24 bars. It's the biggest bar in 22 bars. And before that, biggest bar in 17 bars. So these big bars, and they're growing and growing and growing, were able to quickly take out these supports, right? And above here, you have that high volume distribution. So what happens is the market pulls back to test that distributive area, offering the sell. Boom, boom, boom. All right, now we're on the right hand side. I don't know what's going on here, right? And these are just pullback opportunities because of, I guess I got some selling up here, profit taking, right? And here you see a very clear case of accumulation as well, where you have this 35 and 37. You got all of this here, right? Now, after that, you just move to the right-hand side, and bam! Right there. Ease of movement, and biggest bar, 99 bars. 99 bars, right there. Biggest bar, 99 or 100 bars. What was it? Yeah, biggest bar in 99 bars. After this heavy volume here, indicating accumulation activity, followed by ease of movement, and all that. So this here, no wonder it didn't go pull back, because they're all over this, and then it flew. All right. Okay, so let's go to, I think that's enough for today. So what's the main point here? You've heard of different Wyckoff concepts like accumulation and distribution and effort and springs and upthrust. I'm piecing two behaviors together in a very practical way to show trade location. Those two behaviors are A, accumulation and distribution areas using any volume at price tool that you have or chart that you have, followed by ease of movement, which confirms the accumulation and confirms the distribution, allowing you to look for a pullback entry if you so do choose. So I just gave some examples of that. So after that distribution occurs, like right here, you should have ease of movement, like right here. That will then set up pullback to take the short and get something. All right? All right, folks, thank you. Oh, by the way, this happens on the intraday basis as well, all the time. Take care. Bye.